number 12 has to do with capital budgeting. Capital budgeting is really major purchases. So this is where company would look at, are they going to build a new plant? Are they going to develop even a new product? So they're very major decisions. They're not done very often. For example, in your lives, buying a car is a capital budgeting decision. It's not something you do every month or even every year. It's something you do very infrequently. In fact, the average car purchases are about 7 or 8 years apart, depending on the province. Or buying a house. They're major decisions, and they have major dollars attached to them. So we're going to look at various ways to evaluate, such as if you look at learning objective number 3, payback period. We're also going to calculate internal rate of return, net present value, and profitability index. Some of these will also, by the way, be on your assignment. So they're big dollars. These would be things that go up to the level of the board of directors to determine should we invest or should we not invest. Even internally, like capital purchases would definitely go up to like a VP president level to make decisions on buying pieces of equipment. And what's large piece of equipment for one company is small for another. So you might have a small company and they're going to buy a new computer system and it's $10,000. That would be a big decision. But for a large company, that's a small decision. So it may depend on the company, what do they consider to be capital budget items. And you deal with them in a very different way. A lot more effort is put into the analysis of those such things. So for the city of Calgary, purchasing a train for the LRT, that is a capital budgeting decision. How many should we purchase? What do they look like? What type of trains are they? On and on. They're major dollars. Now we focus on cash flows, not accounting flows. So we have to pay attention and back out things like depreciation, add them back in to our cash flows. And so you also have things like capital cost allowance, which is the government's allowance for tax purposes for depreciation. The 4 that we're going to pay attention to are payback period, NPV, IRR, and profitability index. You're going to need to know how to calculate all of these. Payback period, very simple. So for example, you go to school for, say, 4 periods of time. Each period of time costs you $10,000. So you spent $40,000. When you graduate, you get a job that pays you, say, $8,000 a year more because you have a degree than if you didn't have a degree. So you spent $40,000. In year 1, you get $8,000 back. In year 2, you get another 8. It takes you 5 years to get your $40,000 back. There's no time value of money applied to payback period, at least the ones in this book. So that's a bit of a disadvantage. Nobody would go and spend $40,000 to get $40,000 back. That doesn't make economic sense unless there's other non-monetary reasons why somebody would do that. Believe it or not, I've actually had students who went to school because they wanted to prove to themselves they could get a degree. They weren't doing it for any other reason except to prove that they could do it. And so that's entirely their choice. So the other thing that with payback period, after the 5 years, you say, well, I went to school for 4 periods of time. 5 years, I got my money back, but then I'm not done. Payback period stops once you've got your money back. So in that scenario, it'd be under, say, 9 years would be the overall period of time you're looking at, with the 4 years of, say, going to school, and you would have 5 years to get your money back. So the payback period is 5 years, not 9. It's just how long it takes to get the money back. But after that, if you're like 29 years old, you're still going to be working and you have got your money back. So it's 5 years. So it tells you the time. So you can see here's an example of you have investments in two different items, and we'll go through some in the book, obviously. And both of them have $10,000 investment. Investment A gets money back after 2 years, 5,000 and 5,000. So 2 years to get the investment back. And investment B takes 3.8 years, so partway through year 3, almost into year 4. So A is superior. Now, after the cash flow for year 3 for investment A is irrelevant because you've got your money back. Same as investment B, the cash flow for year 5 doesn't matter anymore. In fact, after you hit $10,000, so even partway through year 4, the additional funds are ignored. So that's a weakness of the system. Net present value is simply the present value of your inflows minus the present value of your cash outflows. So this does take into account time value of money. There are functions on your calculator with net present value. There's also functions in Excel, which you'll do an assignment on, to calculate NPV, and they work very similar. There is an assumption that the first cash flow is negative. So in other words, you spend money to make money. You want to open a liquor store, you have to invest money in stock, shelving, equipment, things along that line. You people right now are investing money in yourselves with going to school, and it's a cash outflow, as you're all very well aware. Then in the future, you will get cash inflows and get your money back and more. One of the things with net present value is if you see net present value of $180, say, why would I spend $10,000 to get $180 back? $180.32 to be specific. That's $182 above your rate of return. In this case, the rate of return is 10% as identified by IY. So it's not that you got $182 back. It's $182 in addition to 10%. So you set a target of a 10% return, and anything above that is acceptable. So to put that in student perspective, let's say you would want to achieve a 75 in this course, and you achieve a 77. The net present value would be 2% positive. 2%. If you wind up with a 71 in the course, your net present value would be negative 4%. So it measures from the target, not from zero. This company didn't make a profit of $180.32. They made a profit of 10% plus $180.32. So it's like, I hate to say excess, but it's certainly additional over and above your target. So it's acceptable. As long as net present value is positive, you would accept it. Here's how you do it in Excel, and I'll show you in the Excel assignments when I do the video for that. So I'll show you in more detail. So internal rate of return is a specialized discount rate where net present value is exactly equal to zero. Now, when I just said, okay, you earn 10% plus $180.32, it seems kind of a little awkward in the phrasing. Like what, one's in percentage and one's in dollars. So internal rate of return will calculate what the actual rate of return is. So in this particular example, and again, we'll do this in Excel. You can do this on your BA2 Plus calculator. This means this company earns 11.16%. At that point, net present value is zero. When net present value is zero is your indifference point. When net present value is above zero, you accept the project. When net present value is below zero, in other words, negative, you reject the project. So the internal rate of return is like your break-even point or crossover point. So this is what I've always thought of. This is the real rate of return. Now, if you are borrowing money at 10%, this is a good idea because you're going to get 11.16% back. So this gives you your rate of return. It's like return on investment, has some similarities to it. But if you have to borrow funds at, say, 14%, it'd be a bad idea to borrow money at 14% when you're only going to earn 11.16%. So it puts it all in percentage rather than net present value does it in a percentage and a dollar amount. By the way, they will both give you the same answer, but internal rate of return is one of the methods. And so far we've had payback, we've had net present value, and we've had IRR, and you use all of these when you are a corporation. Because remember, you're talking major dollars. And again, here's the function within Excel, which we'll go through in your assignment. Profitability index simply takes the present value of the inflows, and rather than subtracting the present value of the outflows, like NPV does, it divides the inflows by the outflows. And it gives you, again, a ratio. If the ratio is greater than 1, you accept. If the ratio is exactly equal to 1, so PI equals 1, it's, again, the break-even point or the crossover point or indifference point. If PI is less than 1, you would reject, because that's not it means you're not getting your money back. So you can see that in this particular case, 2 investments, to summarize this, 2 investments, A and B. You have 2 years and 3.8. 2 years is superior as identified by the highlighted area. So you want your money back as quickly as possible. But would I rather get $180 in addition to my rate of return or $14.14? Well, I like to get the highest net present value. So B is superior. The internal rate of return of 14.33% is better than 11.16. So which would you rather earn on your money? 14.33% or 11.16? The answer is, I want the highest yield. And you can see that the profitability index is also higher for B than it was for A by a very significant amount. The other reason for using profitability index is a very subtle reason, is it factors out size. So it puts basically everything in the same context. To put it in a student perspective, 2 students write a midterm exam in 2 different courses, and one test is out of 50 and one test is out of 70 marks. Well, the student who wrote the test out of 70 is going to get probably a higher mark than the student who wrote the test out of 50. Now, but when you compare who did better or who did worse, you would say, well, what percent did they get? So when you compare marks with other students, which some of you definitely do, so what'd you get? What'd you get? You talk in percentage terms, especially if you're talking to a student who's in another course. You might say, well, what did you get? Oh, I got a 75%. Because you could tell a student I got 19, and I don't know whether that's a good mark or a bad mark. 19 out of what? 19 out of 20 is a pretty darn good mark. 19 out of 50 is something we'd rather not talk about, right? So here's just a summary of what I've been mentioning. You want faster payback period. You want a net present value greater than 0, and the larger the amount, the better. But I will emphasize again that net present value is not from 0. It's not like profit at all. It's not like profit. It is above or below the required rate of return. The required rate of return is the discount rate that you took in chapters 10 and 11, weighted average cost of capital, or simply cost of capital. Internal rate of return, if the IRR is greater than the cost of capital, accept. So that's what would be, I receive 14%. It's my IRR. I can borrow money at 10, accept. I receive 14% IRR, but I have to borrow the money at 16%, reject. And as I mentioned a moment or so ago, the PI, if it's greater than 1, accept. If it's less than 1, reject. And at 1, you're indifferent. You're not going to gain, nor are you going to lose. So here's some CCA classes for you. They're used for when we do the capital cost allowance formula in chapter number 12. You don't need to know this. You don't need to have this at hand for most of the examples. The CCA rate will just be given to you. Here's the CCA formula. What this does is it calculates the present value of all of the cash flows from depreciation after tax. So it might look like a long and nasty formula, but it's actually fairly straightforward. My only suggestion is when you do this, treat each one of the three brackets separately. I've had students in the past try to do all of it at once, and they typically put a bracket in the wrong spot or get the wrong number. And when you really look at the formula, you see R, which is the discount rate, which is the weighted average cost of capital, in there like 3 times. So it's not as difficult a formula as what it might originally appear, but it calculates the present value of all the future cash flows after tax from depreciation. So here's an example, and we'll go through this during class. So here's an example of purchasing some vans, selling the old vans, operating the vans. In this particular case, you're generating some revenue from in the vans. Salvage, the present value of the tax shield. So this is going to save you $4,556 in taxes in today's dollars after tax. And you can see that this has a positive number of $16,324, which means it's a good investment because it's above zero. And in this particular case, that at 12%, so you've earned 12% on your money, plus an additional $16,324. And you set a target of earning 12% or more. So this achieves that. All right, and here's one to calculate internal rate of return. We will use Excel or our calculators for this, and we'll get, this is done a bit through trial and error, which is in a very sophisticated way these days. We have the technology to calculate, and they're using 35%. So 35% compared to the previous one of 12%. Yes, if you lend me money at 12% and I can earn 35% on that, I'll borrow as much money as you'll lend me. And that's the end of chapter number 12. It's a longer chapter and a bit more challenging, but we will get through it together.